What's up guys, welcome back to another video. Today we're going to be talking about the best way to play earnings. And this is involving options, but we're not buying calls or puts. We're actually going to be selling these contracts. And this is a much safer and more consistent, profitable way to play earnings. So we have Uber here, and today is February 10th. So after the market closes today, Uber will announce their earnings. So how would I play earnings on, say, Uber? I would go into the options chain. I would click sell put. And when you're selling a put, it's a neutral bullish position. So you either want the stock to stay flat or rise up in value. And depending on your strike price, you can make money even when the stock goes slightly downwards. So right now the share price is at $63. I would choose something pretty far down, because after earnings, the premiums usually get crushed due to a decrease in implied volatility due to the earnings event being no longer uncertain. So I would do something maybe around the $56 strike price, and for opening this contract, we collect a premium of $105 because it is the premium multiplied by 100 because each contract holds a value of 100 shares. So for this strategy, we do need a bit of collateral. We need the strike price multiplied by 100. So we need $5,600 of collateral in order to open up this trade, as we can see here. So this is for bigger accounts. For smaller accounts, you could do spreads. And what is a spread? It's basically a cheaper way to do the same thing, except you're putting up less collateral. So what we can do is we can use the similar strikes. We will sell the $56 strike put, but we are going to be buying the strike under it. We're going to be buying the 55.50 strike put, and as we can see on the right here, it is now a put credit spread. This is also, don't be fooled by the name, this is also a neutral bullish position. We want the stock price to go up to be profitable on this trade. And as we can see, the collateral is only $50 for a credit of $13. So what happens if the stock goes below our strike prices? Well, if we just did what we call a cash secure put, selling a put, a short put as they call it, if the stock price goes below $56 by February 12th, we will have to buy 100 shares at this price no matter what Uber ends up being. So if Uber goes to $50, we still have to buy 100 shares at $56 each. But no matter what, we do collect our $100 of premium. That is ours to keep, but we do have to buy the stock at a lower price. So you will lose money if the stock absolutely tanks. Now for a put credit spread, what happens if it goes below our strikes? Well, if it goes below your strikes on a put credit spread, you just lose the entire trade. You lose all your collateral. And because of that, I like to do cash secured puts, just shorting the puts, because it's a win-win situation in my eyes. You either collect the premium, or you collect the premium and you get 100 shares of a stock. Now I only do this strategy on stocks that I don't mind holding, such as Uber, Coca-Cola, Disney, which all have earnings this week. So we could take a look at Disney, and we can use a similar strategy on this. So Disney is a bit more expensive, and this is going to be for a lot larger accounts. But Disney is around $190. Something that I would do would be probably a 180 strike for $200 of premium. And this is a strategy I do on a weekly basis, sometimes bi-weekly, depending on the earnings that are being announced. It's a great way to earn a lot of passive income. You basically selling these puts, waiting for the premium to bleed out, and then using the collateral for another trade. If this helped you, or if you have any questions, please leave a comment down below if I didn't explain anything well, and I will either make another video or I will respond to clear things up. Thanks for watching.